Welcome to another episode of Purchase to Profits. I'm Seth Ferguson. Make sure you hit the subscribe button so you don't miss our daily interviews with successful real estate investors. Our guest today has helped save tens of millions of dollars for clients through cost segregation. If you're a real estate investor and don't know what that means, you need to listen to this interview. Yonah Weiss is business director at Madison Specs. Yonah, welcome to Purchase to Profits. It's great to have you on the show.
Thanks so much. Thank you for having me.
It's my pleasure. And you are a very, very interesting guy because you specialize in one of the most, I guess you could call it a money-making niche in real estate.
Yeah, it's more than money making. It's about money keeping. In real estate, people go into real estate because it's a great way to preserve your wealth. It's a great way to make money, right? It's a great investment tool. But here's a way for you to actually keep that money. And that's really what it's about.
Yeah, that's half the battle. Let's say we went out and asked 20 real estate investors if they knew what cost segregation was. I would guess that the majority wouldn't really know how to define it or how to explain cost segregation. So
right.
Are you able to give us kind of a Cole's notes on what cost segregation actually is?
Absolutely. So buckle up, because it's going to be, I'm going to take you through the ins and outs, and we'll try to do it as quickly and as concise, yet as thorough as possible. Okay. In 30 seconds or less. No, I'm just kidding.
Okay. I'm buckled. I'm ready.
It's going to be probably a little more than 30 seconds, but it starts with depreciation. Depreciation is a tax deduction that every property owner gets, okay? Unless it's your personal residence. If you own a property for a business or for an investment, or you invested passively in an investment property, you get a tax deduction called depreciation. Depreciation means that the IRS considers the value of the property goes down as the longer you hold it. And it's an incredible, to me, it's probably one of the most fascinating, almost, what's the word I'm looking for? It's gotta be a good word. I'm blanking on a word. Anyways, the point is, it really doesn't make any sense, is really what I'm trying to get at, if you think about it. Because the property, right, we all understand that the longer you hold on to something, the lower value it has. But that really only makes sense with something that's like a tangible item. For example, a car, that it goes down in value, right? The more you use it, okay? Things that you use go down in value because of its use, right? It has a useful life. The more you use it, there's less useful life. A property, however, that really is most of the time actually going up in value the longer you hold it, which is a contradiction to the essence of what depreciation says. So it's really almost like a theoretical concept that the IRS came up with, and it's great. I mean, there's obviously reasons for it, but at the same time, let's understand it from a conceptual point of view, because that's really what it is, and then we'll understand it, into the details of how it actually practically works. So the conceptual, point of view is that things go down in value, right? So the IRS arbitrarily gave properties a useful life of 27 and a half years. Okay?
That's very exact.
Right, exactly. Or a commercial property, 39 years. They said, if you own a commercial property, its value after 39 years, there's no value left of the property, right? Which is crazy. Which means, how do they do that? What does that mean for us is that you take a tax deduction, a portion, a fraction of that value every single year for the next 27 or 39 years. And that's the basics of depreciation. That's it, okay? And if that were all that there was about depreciation, that would be awesome. Okay, that would be great. We can take that tax deduction, and what it means, tax deduction means that you make income from your property, subtract a certain amount arbitrarily because your property is going down in value when it's really going up in value, and then you're only taxed on whatever's left over. But if we can come up with a way that you can actually take much more of those tax deductions and create, even more tax deductions, which is going to cut your tax liability, meaning cut down on the income that you made of how much you're actually going to have to give back in taxes at the end of the year. That would be great. And that's exactly what cost segregation does. Now, the process of how that happens is with the weird name, okay, cost segregation, right? Everyone, obviously, when they hear that word, they know exactly what it means, right?
Yeah.
Right.
Well, maybe.
Not at all. Like, what in the world is this thing, right? So let's break it down. Cost is the cost of the property, okay? And segregation means splitting it up or allocating the overall cost of the building into tiny details. And that's exactly what happens. We have an engineer, okay, who's trained in the tax code, and we actually, our firm Madison Specs, we have 16 full-time engineers on staff who will go out to visit properties, take a detailed report, and break down the property into tiny details, right? Instead of the whole building and the structure of the building, what depreciates over 27 years, the IRS says that there are things in the building that are personal items, stuff like furniture or appliances or fixtures, wiring, electric wiring, plumbing, you name it, carpeting, anything that's not part of the main structure depreciates over 5 years, which means once you can allocate that amount and all that stuff, and all of that has a cost, you can now depreciate that value, that cost, over the first 5 years. You're taking huge extra deductions over those first 5 years of ownership.
Yeah.
And that's it. I mean, we're done.
I'm already excited. Anything to save on tax. And this is exactly why high income earners love investing in real estate, because through cost segregation, all those deductions, they can like really slash their taxes at the end of the year for sure.
Exactly. And so, I mean, like I said, that's really the gist of it. That's the overall, but it just gets better, because when you have a property, okay, and you're producing income, what you want to do now, let's say you're a person that buys a property and your whole interest is buying this one property, and that's it. You're not planning on doing any more investment. You're just going to buy one property and keep it for the rest of your life, for 30 years, whatever. Now, there are a lot of people that do that, right? Take, for example, a business owner, okay? Someone, let's say, a customer, a client who has a furniture manufacturing company, okay? So he bought a very large factory, right? Like a 600,000 square foot property where, he's using cost segregation to depreciate those assets at a faster life in order to get maximized deductions in the early on, so that he can produce more cash flow in his business, right? Because the more losses, the more deductions you have, the less of your own money that's coming into the company that you have to give to the IRS. So that allows a young or an early business owner will, do that. But many property owners who just buy one property may not want to take those accelerated depreciation, because they're thinking, well, I'm not creating more deductions. All that I'm doing is, right, front loading, say 10, 20, 30% of those deductions to take those over the first 5 years, instead of spreading it all out as a little bit every year for 27 or 39 years. Now, that may be true, and there may be people that think like that. However, there's something even greater that almost everyone needs to know about if you don't already. And this is something called the time value of money. Okay, the time value of money is really what cost segregation is all about. It means that $1 today is not your money. Forget $1. $100, $10,000 is not worth the same it is today as it is 5 years from now, right? The question everyone asks is, well, if I had someone wanted to give me $50,000, would you rather take it all today, or would you rather take $5,000 every year for the next 10 years? I think most people would want to take the $50,000 today because they know that, number one, inflation. Okay, so anyways, the money is going to be worth less in 10 years or 5 years from now. Number two, I think you have a better idea how to use that money. Hopefully, I mean, unless you're just going to like, throw it away, go gamble or whatever. Yeah. But I think most people know how to use their money and can actually use it to benefit them to make more money, as opposed to, letting the IRS use your money to who knows what they're going to do with it.
Well, they might even do a worse job at handling the money than we do, right?
Exactly. And that's really what it comes down to. Do you know how to use your money better than the IRS does? And I think most people would say, I do. And therefore, if that's the case, then, take advantage because you're allowed to. It's your money. It's not like you are obligated to pay money to the IRS every year, right? You're only obligated if you have requirements, meaning if you have tax liability. Of course you have to pay that. But if you don't have tax liability, or you have a way to not have tax liability, why wouldn't you do that? Now, some people like to, people ask questions. I'm sure people have tons of questions about this. One question people have a lot of times is, well, yes, I'm front loading a lot of that, but what happens when I sell the property? Okay, this is a question I get all the time. What happens when I sell the property? Don't I get hit with depreciation recapture tax? Okay, and this is something that, a lot of people don't talk about. They like just talk about all the, nice shiny benefits of cost segregation. And it's true. There is something called depreciation recapture tax, which means that when you sell a property, you have to now pay a tax on the amount of depreciation that you took over the course of ownership of the property. Now, that's not, something that's automatic, right? You don't necessarily have to do that. And there's many ways to even get around that. One way is even just doing cost segregation in itself. Because what you're doing is, you're producing tons of more depreciation, but at the same time, if you have more properties, more than one, you're going to be doing this next year as well, right? Probably the year after that. You're continuously deferring taxes. Then when you sell, you may have to pay depreciation recapture tax, but you can actually put yourself in a negative, right, in a loss by so much depreciation that when you sell the property and you have depreciation recapture tax, when you sell the property, if you have net losses and you have carry forward losses, we do the terminologies, but ask your tax advisor. If you have losses from previous years, you can actually use those to offset even the depreciation recapture tax on sale. So it's like a whole cycle that you're just continuously, deferring taxes, continuously keeping the money that you're making. Eventually, may you have to end up paying some tax? Maybe you might, right? And that may be something, we have to discuss a long-term plan, but it's definitely worth looking into and seeing the benefits. So one thing that I, highly recommend is if you do have a property that you'd like to, even consider doing cost segregation on, talk to someone like myself or other cost segregation firms out there, which will give you a free analysis, will tell you what your benefits will be even before you do it. So you have like a pretty educated decision, once you have, that analysis to say, well, hey, does this make sense or does it not make sense?
Yeah, no, I'm so fired up for this episode. This is awesome. So, lots of our reviewers, either they're interested in single family homes or some are doing some larger multifamily homes. Is there a good place for cost segregation in both of those niches, or does it work better in, let's say, larger multifamily versus single family?
That's a great question. And really it can apply to any type of property. So it doesn't need to be residential. It doesn't need to be multifamily. It can be, we do every type of property, whether it be an office, retail, mobile homes, self-storage, warehouses, golf courses, assisted living facility, any type of property, car washes, you name it, right? Anything and everything can have benefits, and some properties more than others, right? For example, a car wash, for example, just threw that out there, has tremendous tons of the actual property is made up of equipment and stuff like that actually has value to it, which can be depreciated at a faster rate. But the one thing I would say for your single family and smaller multifamily investor listeners is that most of the time, it's not going to make sense on smaller properties. Not necessarily the type of property, but more so the actual value of the building. And that because the depreciation, and we didn't get into the nitty gritty of how that works, but it's based on your basis. Your basis in the property means the purchase price that you paid for the property, not even the value, the actual purchase price, how much money went into buying it, minus the land value. The land itself does not depreciate. Land improvements, however, do, right? You wouldn't even think about it, but when you have a parking lot or you have landscaping, that actually depreciates over 15 years, not over 27 or 39 years. So that means you can take the entire value of the parking lot or the driveway or the curbing or fencing, all that stuff depreciates over 15 years. You can accelerate that as well. So I usually like to say, like, any property that's purchased for over $500,000 has significant tax benefit in there. When you're buying smaller properties, the proportions are much smaller. So you're, again, we're talking about maybe reallocating, let's say on average, 20% of the property. Let's say 20 to 30%. That means that 20% of, $100,000, if you're buying a $100,000 home, for example, is only going to be, $20,000 that now you can reallocate that over 5 years, an extra $4,000 of depreciation a year, to pay a few $1,000s for a study may not make sense to do. And so that's really what it comes down to.
Yeah. And so what we were talking about, the parking lot costs X amount. Somebody might be wondering, how do you even figure out how much a parking lot is worth?
Right. So that's exactly where the engineers come in. So we have a team of engineers, and they'll go to the property, really usually send one engineer to a property. He can handle it, on his own most of the time. And they will actually measure and take pictures and, conduct a whole survey of the property to get everything, every last inch of everything that's there in the property, inside, outside, and then come back and prepare a full study which breaks down and prepares calculations of what the depreciation of all those things are based on industry standard prices or costs for every tiny detail on different things, right? So pavement and curbing and asphalt, or really you think of it as one thing, but they're three different things and have three different price structures. And the engineer, based on his measurements, will know how much will be allocated to each, and then be able to make those calculations also based on the year that it was purchased, also the year that it was placed, was built, okay? Because that actually has a slight factor involvement in the calculation. It's a fraction, but it still makes a slight variation, which the IRS needs to see, and that's part of the calculations going to the study.
Yeah. And if somebody, let's say, bought a property 3 years ago and they're just listening now and they're like, hey, cost segregation sounds awesome, is it too late because they've already owned it for 3 years?
No, it's actually not too late. It's actually something that you can do retroactively. You can get, even if you've been straight line depreciating, you've just been doing that straight line version of taking a small portion every year for 27 years, you can now go back even up to, beneficial wise, even up to like 10 years, it could be really beneficial, depending on the size and the type of property. But you can go back and get retroactively all the accelerated depreciation that you missed over the time that you were just filing straightforward tax depreciation. And you don't have to open up your tax returns in order to do that. You do not need to amend your tax returns. I repeat, do not amend your tax returns, okay? This is something that should almost, in very, very, very few situations have ever been done. Apparently, I've heard from countless CPAs that amending your tax returns is actually like a red flag for the IRS to audit you. But doing what's called a change in depreciation method, you can actually just submit a form that goes along with your tax returns, called 3115, 3115, which allows you to just change the way you're depreciating your property. You don't need to ask permission to do that. It's just something you can do, and you're good to go.
Yeah. So let's say somebody out there is looking at purchasing, let's say a 50 unit apartment building. At what point do they start thinking about cost segregation and start having, all the studies done? Is it before closing, after closing? Can you walk us through that process?
Yeah, it's something a lot of people like to, speak to me for, even before closing a lot of times. Now, this study will actually be done as best done, immediately after closing, so that even though your tax benefit will only be for the year that you buy it in. So if you buy a building today, right, May 2019, the depreciation of that property is only going to be reflected on your 2019 tax returns, which you're not going to file until next year, right, until next March. However, it's important to get the engineer in there as soon as possible, because you can a lot of times get extra benefits by the engineer knowing what was the property like exactly, when it was purchased, as opposed to, sometimes maybe changes were made, sometimes there may be damage or wear and tear, along the way, which may, be harder to account for. So it's best to do that. But I mentioned before that some people like to do it even in the due diligence process, even before they close on a property. Even when they're under contract, they'll contact me and say, hey, Yonah, can I get that, feasibility analysis? Can I get that estimate? Because they'll like to know what their potential tax benefits will be, which will reflect their cash flow, really. So it's something we have, that ability to show even before you even own the property.
Yeah. Oh, that's awesome. So do you have maybe a story or an example of where you went in and really saved somebody a pile of money?
What I like to do there, well, every single property, we've
Yeah.
done we've done over 14,000 studies across the country over the past 13 years since we've been in business. Every property is, saving tremendous amount. But one thing that I love is when the engineer goes to the property and produces a tremendous amount more tax benefits than what we estimated. So like I mentioned before, we'll give a feasibility analysis. We'll give an estimate based on the square footage, based on the unit counts, and it's pretty general. And because we've done so many, the numbers are pretty accurate, meaning the projections are pretty accurate. We like to always do it conservatively because we always try to outproduce, what the tax benefits will be. So we'll undercut that number. What I love to see is when we, project like 10%, allocated to the land improvements, which is 15-year property, and like another 15% to, the 5-year property, depreciates over 5 years, the personal property. And then when the engineer gets there, he is able to find so much more when he actually walks the property. And so I love seeing, you're going to get, $150,000 of tax benefits. That was the projection. And then when the property, when he gets there, we come back and produce the full study and it's like 300,000. It's like, wow, it's like twice as much as I expected. That's always the best.
Yeah. And somebody out there might be wondering, does the IRS ever dispute, the findings of the engineer, and what happens in that case?
The truth is there may be, cases where the IRS has disputed returns. There are a number of court cases over the years and decades that this has come about. Cost segregation itself, all of the rules are determined by the IRS, meaning there's a cost segregation audit techniques guide. This is something produced, created by, and publicized by the IRS. This is not something new. This is not some a friend of mine yesterday I was talking to him and he's like, yeah, this program that you guys have, tell me more about this program that you guys have to save tax. I'm like, it's not a program. This is it's in the tax code. This is this is something that has been in the tax code for 30 years and is something that is real. So it's not a program. It's not something that you just have to. What ends up happening is people may get audited for another reason because cost segregation is not a means to get audited. And when a person is audited, if that ever happens, is few and far between. But when that does happen, they will obviously look at the depreciation. They'll look at the cost segregation as they will look at everything in your tax return. When that happens, if you have a quality cost segregation study, which is produced by a firm that abides by the rules set out by the IRS, then you have nothing to worry about because everything is according to those rules, all the standards, all of the, they have ridiculous things that you need to have in there, like certain nomenclature, of the assets, certain, nomenclature of the different types of property, that if you will make a cost segregation study but won't have that nomenclature, then you may got that disputed, right? Which is ridiculous, but everything. But again, the whole thing is ridiculous. So, we just have to play by the rules and try to get all those tax deductions that we can.
Yeah, and it's always interesting to look at exactly what can be segregated in terms of, some people don't realize like the amount of detail or the pinpoint accuracy. So what are some of the most ridiculous items that can be, segregated?
A lot of people don't think about, like little things. Okay. They'll think about like big things. People think about like, okay, I know that like the furniture and the appliances are, depreciate over 5 years. But when the engineer comes in the property and, shows you stuff like, like you wouldn't even overlook it, like the, the paneling on the walls and stuff like that, or like, security cameras or, lighting fixtures, things like even millwork, okay, or window treatments. All of that has a value and depreciates over 5 years. So, you wouldn't necessarily know what that is. And if a person were to just like take some big bucket items and try to depreciate those on their own, they'd be missing out a tremendous value.
Yeah, absolutely. So Yonah, is there anything that we missed so far? And I feel like this interview was like, like the game show where it's like, no, wait, there's more. So what's behind the last curtain?
I think that what's behind the last curtain, if you really want to know, Seth, is bonus depreciation. Okay.
Oh, I see. It gets better. It gets better.
This is now we're in bonus round. Okay. We're going. Okay. In bonus round, that means that all of that 5-year property and 15-year property and the stuff that you can depreciate at a faster life, the IRS came around about a year and a half ago in the tax reform and said, wait a second. Yeah, I know we said that you can depreciate that stuff and get extra tax deductions for 5 years, right? A little bit every year, a little more. Now, guess what? You can take it all in the first year. Just take all of it. Like what? No. Yeah, take all of it. Just deduct everything you want, right? Just pay no tax. Just go ahead. So this is, it's another crazy thing, like when you think about it. But obviously, there's no really hiding the fact that, Donald Trump is a real estate investor, and, the fact that some people read headlines the wrong way. And I guess the people that produce the headlines have an agenda. Obviously, all media has an agenda. But when people produce a headline that says like, that Jared Kushner didn't pay income tax for 10 years, right? And like use like words and terminology like tax evasion, strategy, right? He used cost segregation, okay? He is a real estate investor, has a net worth of $300 million and didn't pay federal income tax for 10 years because he knows what he's doing, or he has accountants that know what they're doing. And that's really what it comes down to. It's not, there are ways that you just have to play the game. So yeah, Donald Trump had $3 billion of losses, okay? That means that he had negative income tax, right, of $3 billion. That means that even if he made $3 billion, right, of profit, he wouldn't pay any tax because of these rules. Yeah. So you may look at it and be like, well, he's a fraud, and he's in this. That's what the people who made that headline want you to believe. But someone who's an educated person and knows what the strategies of real estate investing have to offer, know that he or probably more likely his accountants are very smart. Okay.
Yeah. And I think anybody involved in real estate, when they see headlines like that, they should be asking, well, how can I do that? It's not judging the person. It's like, oh, wait a second, how can I make this happen for me?
Right. Exactly. And I think the problem is really, behind the media in that regard. And it's really not something I like to talk about at all, but you just have to realize you're right. How do I do that? Instead of what they want me to believe is like, wow, this guy, is a horrible person. because that's what they want you to believe. So they come up with this thing because they know that the majority of people reading it are not educated or not savvy enough to understand that there's a way that you can do it as well in real estate investing.
Yeah, and I think it was Robert Kiyosaki who explained how, you know, taxes are your number one expense in life. So if you should be able, you have to do whatever you can to minimize your tax bill, because that's going to make such an impact on your standard of living, your future investment opportunities, and all that other stuff.
Yeah, exactly.
Yeah.
Exactly.
Yeah.
Exactly.
So Yonah, if somebody's as excited as I am listening to you and they want to get in touch, where can they find you?
I mean, the best place to find me, LinkedIn. I'm pretty active on there every day, you know, producing content, bigger pockets. If you want to directly reach out to myself, we're actually in the moment. I just finished a meeting literally right before this call. We're redoing our company website, madisonspecs.com. So if you go now, you'll see something that was, you know, produced like about 10 years ago. But in a month or two from now, hopefully it'll be updated and cool and up and savvy and up to date and stuff like that. But obviously, you know, those are the best places to find me. Email, phone, you got it, you name it, whatever. Yeah. Find me, just do it.
Yeah. Well, saving money is cool. Don't worry about the website not being cool. Saving money is cool. So I had a blast. Thanks so much for taking the time to do this and sharing these awesome tips.
My pleasure.
Pleasure was all mine. And to you, our reviewers, I wish you well on your journey from purchase to profits. See you next time.